China's stock markets have been among the worst performers in the world over the last few years. But in recent weeks, things have finally started to turn for the better. As I'm recording this, things have come off the boil a little bit, but the Shanghai and Shenzhen stock markets are still at their highest levels in more than 3 years. However, it's a bit of a mystery as to why exactly share prices are rising, not least because corporate profits are getting squeezed by industrial overcapacity. Prices are getting pushed lower by deflation. Consumer demand is still sluggish, and the housing market has been going from bad to worse. I mean, these aren't really the conditions under which you'd expect the stock market to stage a recovery. But Beijing is hoping that something else is going on here, and that there's a foundation to this recovery that's entirely unrelated to the economy, but is instead built on a wave of reforms it's been putting in place over the past 18 months. Reforms that represent a radical shift in the way China's authorities view the role of the stock market. But to understand what's going on, you first need to appreciate that China's three stock markets have never really mattered. In the US, there's this symbiotic relationship between the stock market and the economy. The market more or less reflects the health of the economy. And on the flip side, a strong stock market often helps generate a stronger economy. But that's never been the case in China. The stock markets have always kind of just been out there on their own, not really mattering to what's going on in the economy. But Xi Jinping wants that to change. His vision of China's economic future is one where the stock market is at the center of the action. But for that to happen, stock prices have to go up. Now, in the past, whenever Beijing wanted prices to rise, it would just sort of wade in and manipulate the market with an assortment of tricks, which broadly involved pumping money into the market at one end and imposing limits on people selling at the other. But to put it mildly, this approach has always been a little problematic. It's twice resulted in bubbles, first in 2005 and then in 2015, and those bubbles ultimately popped. And then sometimes it doesn't work at all. And that was the case in late 2023, which was the last time Beijing deployed all the same tricks. And yet this time stocks kept falling. So to realize Xi Jinping's vision, Beijing needs to deliver a more sustainable, reliable market recovery. So a year and a half ago, it pivoted. It put all the tricks to one side and instead started playing the long game. And the long game is all about delivering what Beijing calls a slow bull market. And so the question preoccupying the Chinese press at the moment is whether, after years of decline, is this rally finally the start of the long-awaited bull market? Now, regardless of whether the current rally is a false dawn, Beijing's dreams of a slow bull market are baked in. They're not going anywhere. And understanding them help explain what's actually going on in China's stock markets. So exactly what is a slow bull market? And why is it so vital to realizing Xi's vision of transforming China's economy? That's what I'm going to talk you through, plus an explanation of how Beijing is actually trying to achieve it. A slow bull market is one where prices rise inexorably over time. Sure, they go up and they go down, but there will be corrections and there'll even be crises. But when you zoom out over the long term, those declines fade away and there's just a relatively smooth line going upwards to the right. That's not an entirely unreasonable expectation, particularly if you assume that the stock market reflects an economy's long-term expansion. But that hasn't happened in China. In the past 20 years, China's GDP has grown by more than 600%, but the stock market is up only 300%, which is in stark contrast with the United States. At the beginning of this year, the CSI 300, which is an index that tracks the biggest stocks listed in Shanghai and Shenzhen, it was at roughly double its level relative to where it was after the GFC. Meanwhile, the NASDAQ was 14 times higher. Now, I appreciate that US stock prices have been inflated by quantitative easing and loose money, but even if we make allowances for that, China's market has chronically underperformed. So, why has Beijing decided that it wants a slow bull market now? I mean, China's stock markets have underperformed for years, but this push for a slow bull market is new, or at least newish. I first came across the expression 2 years ago in a commentary published in the Communist Party's newspaper on economic issues, which argued that a slow bull market could become a new reserve for people's wealth. A new reserve. That kind of gets to the heart of the issue. Traditionally, housing was the reserve for household wealth. That's where people put their savings. That was China's machine for creating middle class wealth. Not only is that now over, but the collapse in housing prices has destroyed household wealth, and with it, it's eroded people's willingness to spend. A slow bull market could turn that around by becoming the new engine of wealth creation, a place where people put their savings for the long term in the knowledge that, like in the United States, if you just leave your money in there long enough, the returns will be better than anywhere else. Perhaps even more important than that is that a slow bull market could generate reliably consistent returns on retirement savings for a rapidly aging population, which is incredibly important because China's pension system is chronically underfunded. And the last thing to keep in mind is that by drawing investment into stocks, a slow bull market could help harness the nation's savings to Xi Jinping's vision of economic rejuvenation. Rather than bricks and mortar, people's savings would go into companies at a time that corporate China is under huge pressure to innovate and invest in industrial upgrading. At the moment, corporate China is mostly funded by the banking system, but there's broad consensus among policymakers that the banks, which, they were fine when the economy was dominated by property developers and state firms, but they're not really up to the task of funding this new innovative economy. This quote by an advisor to China's central bank sums it up quite well. He said, "Banks often pursue large projects and large enterprises because they're low cost and low risk, while innovation doesn't need big money, but continuous and stable small money. Bank loans require collateral, but innovative enterprises are asset light and have no collateral. The current financial system isn't what's needed and needs to be reformed. What's needed is a financial system that can support angel investors and venture capital, a system that allows unprofitable but promising startups to do IPOs, a system where large companies can fund buyouts of failing competitors or acquisitions of innovative small companies, a system ultimately that enables firms to take risks and reward success." Now, all of this is central to the new growth model Beijing is pursuing, which I'll get into some other time. But suffice to say, it requires a slow bull market because if people aren't confident the market is going to rise, then there's less reason for them to invest in stocks or to list their companies or even to launch a startup. So, why doesn't China have a slow bull market already? Well, the editorial in the Economic Daily, which was the newspaper where I first came across this idea of a slow bull market, it laid out three reasons. First, it argued one of the main reasons for the prolonged bull market and short bear market cycles in mature overseas markets is the role of medium and long-term capital as a ballast. China's markets are notorious for the disproportionately large role that mom and pop investors play, and they have a reputation for following trends and selling at the first sign of trouble. The Economic Daily argued that if only long-term institutional investors could play a greater role, and they would take a more studied long-term view of stocks, then China would have the foundation for more sustained gains for their stock markets. Second, the paper argued that a slow bull market is impossible without first dealing with the worries people have about investing. And it reads like this: "We must continuously advance the modernization of the capital markets regulatory governance system and swiftly crack down on illegal and irregular activities such as stock price manipulation, insider trading, and fraudulent listings." In 2001, a famous Chinese economist purportedly said that the difference between China's stock market and a casino is that at least casinos have rules. Now, it goes without saying that a lot has changed since then, but there's still this general perception among the Chinese public that the only people who really make money out of the stock market are insiders who can play the system. The Economic Daily argued that the only way ordinary people are going to put more of their savings into stocks is if they can be assured that the market is fair. And third, the Economic Daily argued that investors must be rewarded with real money. And specifically, that meant companies had to pay out dividends. Now, the irony in all of this is that the essay was published in mid-2023, literally weeks before China's Financial Sector Authority engaged in their last attempt to manipulate a market recovery. Now, that persisted for maybe 5 or 6 months, and then in February 2024, the government agency in charge of overseeing the stock market got a new chairman, at which point all the old tricks stopped and the authority started doing everything laid out in that Economic Daily editorial. So what does that look like in practice? Well, the blueprint broadly has 3 parts. The first being rebuilding trust in the market by imposing discipline. The second is rebalancing the market toward long-term investors, or what China's authorities have taken to calling patient capital. And the third being delivering real returns. Now, of those 3, the last one is perhaps the most straightforward. Beijing has demanded that listed companies increase the size and frequency of dividend payouts, and it's pushed companies to do share buybacks. They've also forced securities, brokerages, and fund management companies to lower their fees so that investors get to keep more of their returns. Now, that second part of the blueprint, efforts to boost the role of patient capital, have mostly focused on insurance companies, specifically by raising the limit on how much they can invest in stocks, a move that the chairman of the securities regulator said would result in at least hundreds of billions of long-term funds being added to A-shares every year. But additionally, authorities have also freed the National Social Security Fund, which is one of the pillars of the pension system, to invest more in stocks. And Beijing, which is the central government's financial holding company, it's been steadily investing more and more in ETFs. Now, none of this is going to suddenly rebalance the market, but altogether it's resulting in, it's slowly moving in that direction. The hardest part of realizing that blueprint has been rebuilding trust, because that requires changing the way that people perceive the market. And there's no one thing that will create that sort of cultural change. So instead, Beijing has launched a full court press. It has been going after financial crimes more aggressively. It's exerting greater oversight over who gets to do an IPO. It's cracked down on the revolving door of regulators going to work in the financial sector. It's tightened financial penalties for corporate malfeasance. It's forced founders to hold on to their stocks for longer after listing, made it harder for insiders to sell shares. It's trying to provide a better protection environment for whistleblowers, and it's forcing loss-making companies to delist, along with a bunch of other stuff. But the overall approach is best summed up by the chairman of the securities regulator again, who said, "Upholding the law and respecting rules are the basic prerequisites of running a successful capital market." Will this approach work? Well, it's important to keep in mind that China isn't reinventing the wheel here. In the 90s, Sweden reformed its retirement system in a way that resulted in patient capital playing a far greater role in the stock market, and that resulted in rising share prices and a far more dynamic financial system. More recently, Japan sought to boost stock valuations by restoring trust. In 2015, it introduced its corporate governance code, which imposed greater discipline on listed companies. And the previous year, it rolled out a stewardship code, which was designed to encourage institutional investors to impose discipline on the companies they invest in. Those reforms are widely seen as a major catalyst for the bull market in Japanese stocks after 2016. So, are we seeing the start of a slow bull market in China? Well, by definition, we're not going to be able to tell for at least a couple of years. That said, the security regulator seems to already be taking responsibility for the rally. It recently published a notice saying that at a recent gathering of academics and industry experts that it hosted, everyone agreed that as a result of its reforms, confidence among all parties has been significantly strengthened, which has led to a stabilization and rebound in the A-share market. The challenge will be avoiding another boom-bust cycle, particularly if mum and pop investors, frustrated by chronically low interest rates and the ongoing property market slump, chase rising share prices as the only place where they can get a decent return on their savings. If China ends up with another stock market bubble that ultimately pops, it will set back efforts to rebuild trust in the market indefinitely. Now, what's important to keep in mind is that the stakes here are really high. If Beijing doesn't pull this off, then there isn't really an alternative for building middle-class wealth. The pension problem will be far harder to deal with, and delivering a more innovative, technologically advanced economy, that will be far more difficult as well. I also appreciate that a lot of people will hear this and scoff that it is absolutely unachievable. I mean, in fact, the critique of many foreign investors is that China's stock markets are uninvestable, which is a critique built on Beijing's ability and Beijing's willingness to sort of arbitrarily intervene in markets whenever it likes with no reference to the interests of investors. None of what I've been talking about just now is going to change that. Beijing can still intervene in the economy however and whenever it likes. But on another level, these reforms are all about convincing both locals and foreigners alike that China's stock markets are in fact investable. Not because they're free from the influence of the state, but because they're fair, because they deliver steady, reliable returns, and because they present the opportunity to invest in some of the world's most exciting and innovative firms. Now, that's not presently a realistic description of China's markets, but that's what authorities are striving for. Now it's just a question of whether they're going to do enough to pull it off and whether the market will respond the way they want it to.